Hello everyone, I'm Sunny Goklani, and in this video, I'm going to present to you the $1,000,000 spreadsheet, which is a simple financial model built in Excel, which answers very basic questions in life that you must have thought about, but you've just not charted your plan to it. Questions like, which age will you become a millionaire? How much net worth will you leave when you die? Questions like that you've thought about, but never put to paper. This video, I'll present to you this spreadsheet model that I've built, and hopefully it will give you something to think about and to plan your life by. Let me share my screen here, and I will dive right into it. I will start with explaining you what this sheet is about and how does it work, and then I'll tell you about 5 things that I noticed which were very surprising when I did this exercise. And hopefully, if you understand those things, it will give you a good information about very basic blocks in how to build your way to $1 million and even $1 billion. So this $1,000,000 spreadsheet can as well be a $1 billion spreadsheet or however you left behind. So in this case, what we're starting with is, I will start with saying, first of all, that I know there exists financial calculators, simple interest and compound interest calculators out there, but this, the purpose of building an Excel model behind that is because first of all, you can have custom cases. Your income, for example, financial calculators would take one income, number of years, the same rate of return and stuff like that. But what we're doing here is because it's our own model, we can customize the inputs as much as we want. We can be flexible. And at the same time, we would understand what is going on, what is going in. So we would understand our finances better because we're understanding how it works, not just the final result. So in this case, what we're looking at here is because we have to take one example to show you what I'm going to show. And this is a case on the screen which we've taken. So for example, someone graduates out of college. GI is the gross income. So let's say when they started off, they were getting gross income of 50,000. And then over the time, they got promoted, they got raises, they maybe changed companies and they got different raises throughout their 20s. They reached about 100,000 income when they were 35, and then they kept rising up and till, let's say, in their 50s. And after that, they had to settle for whatever role they could get. Their income declined, and then they took whatever jobs they could get, and maybe say they did what they love to do. And after 75, let's say they retired, they just get their dividend income or very basic income of any residual business they have, which gives $10,000, right? So this is a basic income graph. And then now we will take this input, this person B, for example, whose gross income is this much, and we'll understand how many scenarios his net worth would be, what age he will become a millionaire, and how much net worth will he leave behind. So this tab, MDSS, the $1,000,000 spreadsheet, is the model that I was telling you. Let's first understand really quickly, in interest of time, in a couple of minutes maybe, how does this work? So this column is of age. So it goes from 22 and it goes till the end of his life. We've taken 100 as the extreme. 79 is yellowed. That's the average expectancy of life in US. This is his gross income. And this is his investable savings. So 2 main variables are, first of all, savings rate. So for example, when he starts with 50,000, he saves 25% of it, which is 12,500. So at the start of the first year, he doesn't have anything invested. At the end of the first year, he has 12,500 plus returns are 250. Why? Because it's 10, we're also assuming the rate of return. So for example, he generated 4% over 6,250 because at the end of the year was 0, and at the end of the year it was 12,500. So we have this column which calculates what was the average amount invested in the year, and then we calculate 4% of that. So that is what is the return generated in the year. Net worth at the end of the year is this much. Now 12,750 again is the start of net worth, and the end for the second year, the returns generated are again 4% of the average invested in that year, which was 19,000. And at the end of second year, they basically have 12,750 plus whatever they invested in the second year and plus the return in the year, right? Now this keeps on going every single year. Again, the assumption is throughout their lifetime, we're taking an average rate of return they generate in the lifetime. It will never be smooth the way we're putting it here. But the point is to chart if you can generate that return and if you can save that savings rate, where will it get you? So in this, by the age of 79, in this scenario, by the average age expectancy in US, he would have generated his 5 million net worth. And by the time he dies, or let's say extreme of his life, let's say till 100 years, he would have generated $11.7 million of net worth. Now there is a little bit of formulas going on here, which calculate which year he becomes the millionaire in. That's 47, and net worth of it, and the end of the extreme 100-year period is 11.7 million. These are some derived matrices, matrix, which calculate like how much invested cumulative savings he invested in. This just adds the cumulative amount of savings, the average amount of dollars invested in that year, upon which we will calculate the percentage return, period increase in net worth, the ratio of invested and returns in dollars to net worth. So that's basically how the sheet works. And that is the scenario we're taking: 25% savings rate, 4% rate of return, and this is the income profile of this guy. Everything from here on would be my interpretation of the results that this sheet generates. I think everyone should put this sheet together to understand from their own profile how their life and net worth would look like. Two warnings. First of all, we have not considered tax implications. At the end of the sheet, I have added what the net worth would be after everything is sold at the end. So that's at 15% long-term gains. So that expects that you would not do trading throughout the year. I've put different sheets with what-if analysis, with tax analysis. That is a topic of further video, which would show you how your returns and net worth would be impacted by how much trading you do, how much taxes you generate, how much fees you generate. But that's all a separate topic for a different video. So for this video, we've not taken the tax implications throughout the years, just in the end, and we have not considered inflation, because I wanted to put everything in terms of today's dollars, so you would understand how much the net worth means to you in today's dollars. Of course, if we discount them, your net worth would be much less, and then it doesn't make sense. For example, when you today think of being a millionaire, you think of being a millionaire now, having $1 million now. And again, millionaire would not be worth it many years from now, just as it's not as much a lot of years prior it was. But to keep the dollars very relevant to your understanding, we've kept it without inflation. All of those things can be added. More sophisticated model can be a topic of different videos, but this is very simple. So let's start. In this case, let's start with 5 things that I found very interesting, which tells you a lot about this exercise, which tells you a lot about where and how much you would be worth, and what are the 5 essential things you have to take care of to understand how much sensitivity it has to where do you end up on the net worth profile. So I've added some charts on the right, which I would explain you through, and I'll walk you through everything that I'm talking to you about. So first of all, the first thing that really stood out was everything in the nature of the charts is exponential. Everything is exponential. So first of all, the very basic chart of net worth by year, right? He was at age 22, that's age 100. Look at that. Again, it would not be this smooth, this parabolic, this, because the rates of returns will deviate by time. We've assumed the average rate of return over his lifetime and applied his savings. So look at the exponential nature of this curve. Second, this is a chart where we've charted gross income versus increase in net worth per year. So this is his, this graph looks like the same graph here, right? That is the chart of the gross income over an entire lifetime. And this looks pretty sad. For example, you'll keep rising and then you probably get to your 50s and 60s. And unless you have a business where you have increased ownership of increased value, it's a pretty sad life to look at this chart in a 100-year life and realize that your best years are over pretty quick. That's a pretty sad life to look at, really. But then again, the good part comes here. When you plot this chart, which is gross income, which is the blue line that we saw, the sad line, versus increase in net worth per year, how much your net worth is increasing. You see, when you start off your basic source of income, your basic source of increasing in revenue, increase in net worth is your basic income, your gross income. And then this green line is how much net worth is increasing per year. For example, if you might be making 60,000 per year now, if you look how much your returns are, you might still feel that your contribution to the salary is what is the primary driver of increasing net worth. But this is not always the case. See the effect of the scale. Now this line is growing, and at age of 50 is where I've stopped it for now, where it crosses your gross income. And if we increase this range to 83, which is, I believe, the year 100, look at this line. Look at this line. The later half of your life, your increase in net worth goes exponentially. Well, the moment you start making lesser and lesser money after 50, your net worth is growing so fast that, and exponentially, if, of course, everything else stays the same, which we'll talk about. And look at this. This chart shows the increase in invested savings, right? You're earning 50,000 year one, you're just saving 12,500. So your savings, which are invested, follow the same curve, but has less absolute amounts. And this is plotted versus returns generated, which is only the returns that are generated, not the net worth, but the return your portfolio generates. Again, when you start off at zero, year number one, remember you invested 12,500 and you generated 4% on the 6,000 to 2,250. So that was pretty low. And it starts out of nothing and it increases. And still, if you're in your late 20s, early 30s, or mid 30s even, you might realize that it is nothing in compared to how much you are feeling your net worth growing, which is a very slow pace. But look at this, how it increases with time. By the age of 100, look at this chart. The savings that you've invested appears so small, so tiny in the whole picture of how much your net worth and returns generated actually are more than this. So for example, realize this. In this case, the girl, whoever, like the person B, is generating 450,000 worth of income in his year 100, in their year 100. So they were earning at the maximum 150,000, right, in their 50s. But at the year 100, they're generating an income of $450,000. This tells you how much the compounding effect on your returns take place in your portfolio. But then again, to be able to generate that much income in your year 100, to be able to make $11.7 million at the end of year 100, this person did a lot of things. They saved 25% of whatever they made. First of all, they generated that income profile. Second of all, they just saved 25%. And third of all, they generated 4% annual return per year. And fourth of all, they lived 100 years. That brings me, what I just said is an outline of everything I'm going to talk about. So first thing was exponential nature of everything. And the rest 4 points comes from that statement. Let's look at that. The second point is, which is very essential. If you want to be this person or better, very essential, the next 4 point I'm talking about. The next point I'm going to talk about is the length of age. This person lived 100 years. Basically what I'm saying is he generated 78 years of invested income, right? So what it says is, if you're going to live that life, if you have to save this much, it is really important how long you live. The longer you live, the more you'll make, because looking at the exponential nature of the curve, your money almost goes at an accelerating pace as you grow older. If you look at this chart, right? So for example, if you for example saved 50% of everything you made, this is after all the expenses, how much you save that it can be expended. And if you generate 20% return, that Warren Buffett example generated in his life, you'll become a millionaire at age 31. Guess who else became a millionaire at age 31? Warren Buffett himself. Again, if you look at his net worth chart, he became a millionaire at age 31. Look at his net worth chart. It literally exploded exponentially. This chart explains that he was worth $58 billion when he was 83. Now he's 87 and he's worth about $84 billion. Look at the exponential nature. What if he died in his 50s? He would be nowhere close to where he is today. And that's the beauty. The beauty is to be that rich. I'm not saying that you'll be 84 billion worth if you live 87, but to be that rich, you have to live long and you have to invest. You have to have a long investable career. Buffett started investing when he was 13. Now he's 87. He is almost the chart that we're explaining, right? And first of all, you have to start investing early and you have to live longer. This is where the importance of health comes in. Often, to become richer, what people say is they're going to generate more income, they want to save more, they want to generate that 1% more rate of return, which we'll get to why it's important as well. But what I'm saying is, one thing we might often discount, which is really very important, is how long you live. So if you want to be really rich when you die, please make sure you have a healthy life, healthy lifestyle, and you live longer. That is something which is discounted, but it's really important. So that was my second point. Earlier you start and the longer you live, the more richer you would be. Again, very simple. Many of these things would be very obvious, but it helps to look at it this way in the spreadsheet and know the importance. The third thing I'm going to talk to you about is the savings rate. The savings rate here is basically what I'm talking to you about is at the end of the day, how much you make. For example, if you make $100,000, at the end of the year, with all the expenses, you are able to invest $25,000. So that is a 25% is a savings rate. Now, this is a really important factor in your savings. So this person, which was worth $11.7 million, how sensitive this is to the savings rate, right? So on an average, unfortunately, for the whole of US, the average is 2.7% the savings rate, which is really, really low. And because it's a consumer economy. So this person, which was being a millionaire at 47 years, would have been a millionaire at 94 years and would have died with a net worth of 1.2 million instead of 11.7 million. That is the difference of the savings rate. And another thing is the whole model is based out of how much invested savings you've done over your life, right? How much savings you've invested. So this doesn't actually care. For example, if the savings are in starts from 12,000, goes to mid 30s, 40s, 50,000s, right? So let's take a month of this. This period in his life, in his early 30s, the person is saving $20,000. This doesn't care if you make $100,000 and spend $80,000 and save 20 and invest 20. Versus a person who makes $1 million, has a lavish lifestyle, spends $90,000 and saves 20. This doesn't care. The model doesn't care. It just cares how much you save and you put into your investments. So basically, the little guy has a really much more advantage than you think over the big guy if they live frugally and under their means. The differences in lifestyle, of course, you will say he doesn't live the same lifestyle as the $1 million person who spends $90,000. But hey, they're worth the same at the end of their lifetime if the little guy is saving percentages more. So saving percentage really very important, but it's independent. The model is based on the savings invested, not percentage, not the dollars made. So you can save more by having a higher savings rate. Very, very important. Third thing that I'm going to talk to you about is the rate of return sensitivity. Again, this is something I cannot emphasize more, how 1% change means a lot about how much you're going to be worth. Right? So, for example, 11.7 million, if they were a really bad trader in stock markets over the entire life, let's say they generated minus 2% of returns, right? If they generated minus 2%, when will they be a millionaire? Oops, not in this life. They would end up with $500,000, and this is what their net worth would look like. Again, not as smooth. The returns would change over time, but I'm just saying in the broader picture. If they say if they generated zero returns, they would just be worth as much as they invested, which was $1.4 million. They'll become a millionaire in 57 years, basically whenever they've made in total of $1 million. Our case takes it from 1 point something billion to 11.7 million, and they become a millionaire in age 47. If you're able to generate, and this is a real table that I put together, just look at this, right? Every percentage you generate more returns, this increases your rate of return. Sensitivity changes your net worth exponentially. And you just extended the last one. If everything else is the same, the income profile is the same, savings percentage is the same. If they generated 20% return, what Warren Buffett did in his lifetime, just look at this. The new bar, which is $163 million, is their net worth. every bar is not even visible on this case. So that is the sensitivity you generate. And if you put the American averages together, American averages are the savings rate of 2.7%, and the rate of return, if they invest in bonds, they would be worth $500,000 in their life, at the end of their life, and they will never become a millionaire, which is sadly a reality, which is very sad. But if you can increase any of these two, if you can still have the same savings rate, same lifestyle, and invested in stocks, the average 8% return on S&P, you'll at least become a millionaire by 67, and you'll be worth $12.7 million. So where you invest your money, how much returns you generate is, of course, very important. You know it's very important, but this shows you. And in the case we were talking about, one more thing is by the end of their investing career, you can see that they would be rate of return of 4% is what we're talking about. You'd see that out of 11.7 million, they just put in 1.3. The rest 11 million, the rest 10.7 million, 6 million, 10 point something million was the return generated. So at the end of their life, the only 12% is what they actually invested. 88% is what was the returns generated. So rate of return, of course, really important, as you know, but this just explains you the sensitivity. The last thing I'm going to talk to you about is this, even in this case, even if you save like 50% and you generate a 20% return, right? You'd still become a millionaire at age 31, and you'll still be worth $327 million. You'll be asking, how can I become a billionaire? Sorry. Of course, the answer to that would be if you just generate an average professional life and keep having salary, the chances are low. So the obvious way out of that is if you start a business and sell it for a lot more money. And in which case I did this little study of how much an average age of an entrepreneur is in US. It was 42. And let's say you sell your company after 5 years, so that's 47. So I did a number of cases and simulations about if you want to be a if you want to be a billionaire by the average age you die, how much you would have to sell your company for. The number came out to be $226 something million. Let's see. If at the age of 47, the number here was 121,300,000. Yeah, if you sell your company by the age of 47 for $121 million, you'd be worth $2.4 billion. I think, let me correct that model a bit. I think I did something different, but I'll come back to that in the comments. But what I did was I made sure like how much money you'd have to generate for you to become a billionaire till you die. And the amount came out, I'll just correct this and update you in the comments, sorry for that, was $121 million is what you will have to cash out of your company if you want to be a billionaire by the age you die. So I've generated this sheet, which has many different scenarios and more information. I hope the sheet was helpful and to understand your finances. And of course, anything I do is open source. I can share this sheet to you. Just leave me a comment or email me at sunnyk.goklani@gmail.com or get in touch in any social media, and I'll give this, share this to you for free. I'll now stop sharing my screen if I can, and hope this was really helpful. And hope this was really helpful. And if you think that, I hope that I gave you something to think about. And I hope you are on your way now with your clarity of different topics, that these are the 5 things you need to do to get on the way to a millionaire and a billionaire, and things you should keep in mind now because the effects are compounding. Thank you very much.